Hi everybody, welcome to another episode of JB and D's Market Sniffs. This is episode number two. Last week we introduced, not last week, 2 weeks ago, which was last episode, we introduced ourselves. I introduced JB, which is me, and D, which is Dino, my dog, and we let you know what you can expect from this podcast. But yeah, let's dive right into it. Let's start with China. Alibaba. So last week a big point that I made, not last week, again, last episode, a big point was Alibaba, my bullishness on Alibaba. Back then we were at 110, 105 between that zone. Since then we've jumped. We're back at 120. So a nice move since then. Yeah, I was letting you know my bullishness on the short term for this stock. It's really nice to see. Now my calls are at a nice margin of safety. A point that I made was that long term, like long term, big picture momentum was upwards, and you want to capitalize on these very big dips, such as the one from earlier in the month in July. And we did just that. Pretty much did the hard work now. Um, as long as 113 holds on Alibaba, um, I honestly see 140s again by September. Um, so that would be really great. 140s by September, or at least by mid September. And then, yeah, because over 120, there's no resistance until 140s, 150. And then over that is another huge move to 170. But we'll cross that bridge when we get there. And I'm not only bullish Alibaba, I'm just bullish on China in general. I'm bullish the Chinese economy. I mean, man, okay, I should probably do like video formats for my next episodes so that you'd have the option to just listen to the audio or listen, watch the video with the charts because I'm looking at charts, but you can't see them. So you don't have a visual um of what I'm looking at. But basically, the sorry, quarterly GDP growth year on year change percentage for China has been pretty good. It's been pretty good since the start of quarter one 2023. Um, it's been holding up pretty well, and that's been after before that was the housing crisis over there in China, where most investors had their investments in the housing market. So explains why consumer confidence dropped a lot, a lot over there in China. However, things have been stabilized pretty much since then, other than the deflation. But once that deflation stops, um, and once it reverses course, these Chinese consumers will want to start spending again because they'll start thinking like, okay, prices are gonna start going up now. I should spend. I should start buying now before prices are higher, right? Because right now it's like there is no urgency to spend because there's deflation. Prices keep going lower and lower. Like, so you don't feel an urge to spend. You don't have to worry about prices rising. You know what I mean? Um, and apart from that, these Chinese consumers have lots and lots and lots of money to spend. They just have it all saved up in their bank accounts. And once they start spending, which there's been signs that slowly starting to start spending again. It's gonna be great. It's gonna be great. So I'm playing this through Alibaba, but not only Alibaba, but also through Estee Lauder and Canada Goose. Okay. A big percentage of Canada Goose revenue comes from China. Estee Lauder, another big percentage of their revenue also comes from China, and Alibaba is based in China. Okay. Not only that, but the U.S. dollar has when the US dollar is weak, international equities perform even better. Okay? Sure, Canada Goose and Estee Lauder are not listed in um internationally. listed on the New York Stock Exchange. However, again, like I said, a big percentage of their revenue comes internationally. Okay, so that's one way I'm playing it. And um, yeah, I mean, they'll start spending eventually. They slowly are, but like once they start spending, oof, gonna make some good money. And but yeah, okay, that's Alibaba. Um, let's go to small mid caps, U.S. equities. I said I'd go into that this episode. Um, pretty much the play behind this is earnings revisions, earnings growth projections. I mean, um, well, let's see. Let's start off with this. I got this from the BOFA. I think it was the Rick report. All U.S. sectors, okay, all U.S. sectors trade at or above historical trends. Only U.S. small cap value, and international dividends trade below long-term norms, okay? Again, only U.S. small cap value, and international dividends trade below long-term norms. Nice, okay? Uh, let's see. And where did I have this? Where did I have this? Okay, here's earnings growth. Okay, realized and consensus EPS growth for select U.S. equity indices. For the Russell 2000 in 2024, it was negative 11. 2025 this year, 21. 2026 next year, it's in the 30s. Okay, let's go to S&P Midcap 400. 2024 and 2025 was 1. 2026 jumps to 18. Okay, equal weight S&P 500. 2024 and 2025 was at 5. 2026 it jumps to 13. Okay, big jumps for these mid caps, equal weight, and Russell 2000. For the S&P 500 and the Nasdaq 100. Let's do it Nasdaq 100. 2024 17, 2025 14, 2026 16. Pretty much stagnant. S&P 500 2024 last year 10, 2025 this year 7, 2026 next year 14. A little bit of a jump, but not as much as equal weight S&P 500. Not as much as S&P mid cap 400. Not as much as the Russell 2000. Okay, so you want to be where the earnings growth is projected to grow the most. Okay, and the Max 7 are still dominating earnings growth. Um, however, starting quarter three of 2025 is when the other 493 companies um are expected to see an upward growth projection again in the earnings. I wish I could show you this chart. See, next time I'll do a video format. And by the first quarter of 2026, the Max 7 and the other 493 companies earnings growth are supposed to be at level. They're supposed to be equal. Okay? So while Max 7 earnings growth decreases from here till then, the other 493 will increase from here until then. Okay? So it's pretty much just like an earnings growth play. Okay? And um yeah, there's more things, but that's pretty much just keeping it simple. Let's see what else. Oh, okay. So stocks are at all-time highs. However, now is the cheapest it's been to buy insurance on tech companies. This is with earnings coming into play, okay? So again, stocks are all-time highs, and yet the cost to protect earnings in tech is at all-time lows. Okay, so you want to buy insurance when you can, not when you have to. You want to buy earthquake insurance before the earthquake, not after the earthquake. You want to buy fire insurance before the fire, not after the fire. Okay, you want to buy hedges before the pullback, not after the pullback. Okay, and then again, none of this is financial advice. Please talk to a financial advisor, consult a financial advisor. Anything that I say is opinion only. not financial advice. And any opinion that I have as of now is subject to change since the upload of this podcast, since I uploaded this audio, since I uploaded this video, and since when you're listening to it. Okay, my opinion right now can change by the time you're listening to this audio. Keep that in mind. Um, okay, so what I've been doing, again, opinion only. This is what I've been doing. Please consult a financial advisor for your own needs. Um, I'm looking at overextended charts that have nice short setups in tech and that have some decent amount of put flow in the last 30 days, and I'll take some hedges on those. So far, I did on TXN. TXN dumped 10% plus after the earnings. I did it on APH. That was a break-even play. They pumped on earnings. Then they had a conference call, and it just stumped um midway through the day. I don't know why they had the earnings call during trading hours. So I exited at even when it dumped, but then it doubled after I sold. But whatever, it doesn't matter. That's hindsight. And then I did it on Google. However, on Google pumped on earnings. They actually had a pretty good earnings. I am not gonna lie. But those puts are for November, so I'm gonna hold them on down around 40%. And then this week we have Meta and Microsoft amongst other ones like Apple and other tech companies. However, Meta and Microsoft are the ones I'll be looking at this week. I haven't bought any put hedges for those yet because I don't see any like significant put flow for these names. But if I do, then I'll take some. If I don't, then I'll steer clear from them. Okay. So yeah, do with that information what you want. Um, I'm talking about the insurance information. Um, but yeah, nothing that I say is financial advice. Please consult your own financial advisor. Okay? Um, yeah, let's see. Earlier today we had Trump say that he announced a deal with the EU that they'll do a 15% tariffs on autos. That the EU will buy a vast amount of military gear from the US, that the EU will agree to buy 750 billion worth of US energy, that the EU will agree to invest 600 billion more than previously in the US. I don't know. I take all that with a grain of salt, honestly. That they won't allow US that they won't allow windmills to be part of the US, that pharmaceuticals won't be part of a EU deal. He extended the tariff pause another 90 days for US and China, that China's close to going um making a deal with the US. And yeah, I wonder how the Chinese market will Chinese equities will react to this news. Wonder if they'll pump or if it'll be a nothing burger, because honestly, this tariff news and everything is just becoming redundant. It's becoming like a whatever scenario at this point. I don't know. So I'm curious to see how it reacts. Um, but yeah, I mean, pretty much covered Alibaba, where I project it going by mid-September. We covered US small mid caps, pretty much both. Okay, so both those things we covered them. Pretty simple, pretty simple. I didn't go so deep into them. If I wanted to go deep into them, I'd have to make their own episodes, like an episode specifically for China, Baba, an episode specifically for small caps, mid caps. Um, but it was just like a nice overview. This is a nice overview. And what else? Gave like the insurance thesis as well. We talked about the EU and China and US news that just came out this morning. Oh, but yeah, earnings for next week. Again, we have Meta, Microsoft, Apple, uh, ExxonMobil, Chevron, Reddit, Amazon, I said SoFi, Visa, Whirlpool, Etsy, Hershey. I'd like to invest in that under 130. However, never really got it after that April dip. So I missed out on it. It's been pumping since they announced a new CEO. It's okay, whatever. If I miss it, I miss it. Etsy. let's see. I saw some Costco for that. I don't know if I'll do anything with it, but yeah. That's it for this week. Oh, we also have FOMC on Wednesday. I don't expect anything out of that this week. Economic data has been pretty mixed. You'll see some softening, some weakening in some data, and then you'll see some data show that everything is fine. So I don't know. For me, it would just make the most sense the for Powell to just stay on his hands and not do anything this meeting. And yeah, I mean, even Trump said it himself when he met Powell a couple of days ago at that one building, saying that the U.S. economy is resilient or strong, one of those. And why would you want to cut when the economy is strong, right? So it just doesn't make sense. Um, Whatever. And if, let's say, hypothetically speaking, they do cut, which I really doubt, I actually think that would be bearish. I don't think that would be bullish. Um, and if that does happen, I guess I'll make an episode on Wednesday specifically for that. But I doubt it. I actually think we get nothing from FOMC. Um, but yeah, I don't know if I'll do this on a weekly basis. So episodes every weekend or maybe twice a week, midweek, like on a Wednesday and then on the weekend. Still to be decided. I guess we'll see how things go. Again, my motto from last episode, my first episode was just make it exist first, make it good later. Okay? So we'll just see how things develop. But yeah, thank you for tuning in for another episode of Market Sniffs by JB and D, and we'll see you guys for the next episode. See you guys.